Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today we will discuss 800 years on the financial markets.
Hello everyone, my name is Radovan Vojtko, I'm Head of Research and CEO at Quantpedia. Today we will discuss history, and to be precise, we will discuss 800 years of the history of the financial markets. So we have probably mentioned several times that we love history, and more than just once. So what we like on the academic studies that use the long-term data is that they offer a bird-like view on the financial markets. So the daily noise and the ebbs and flows, they retreat in the background, and you can see very nicely the macroeconomic and geopolitical trends. This top-down analysis, it helps to design the asset allocation, and it helps to shape the overall structure of the portfolio. The portfolio can consist of asset classes or the portfolio of systematic trading strategies that may trade on higher frequencies. There is a paper from Brian Taylor that I would like to recommend to you. The Brian Taylor is from a company called Global Financial Data. I mean, if you are looking for a high-quality long-term data, I mean really hundreds of years of data into the past, I really recommend you to go to Global Financial Data. They have probably the best historical data I have ever seen. So what is his paper interesting about? He used the data and he showed what is the risk premium and what was the performance of the equities and bonds in the past eras and in the history. And the paper starts in the 13th century. So I mean it offers 8 centuries of financial markets. He divides those 8 centuries into 5 eras and 20 different periods, and he shows what are the returns of the stocks, to bonds, and especially what is the equity risk premium, so what is the outperformance of the stocks compared to the bonds and compared to the bills. Here are some tables. Here we can see what is the performance of the stocks and what is the performance of the bonds through several different eras or several different historical periods. Paper is treasure trove of charts, tables. You can see what is British stock market prices, what is the world market stock index in the 19th century, what is the share of market global capitalization by individual countries over the history. I mean, how the individual countries were stronger and other were weaker in the past, how that changed and how it was reflected in the performance of the equity market. What is the main takeaway from the whole paper is probably that the equity risk premium is not stable. It's not stable at all. I mean, it really depends on the era. It can be significantly positive, for example, during or after the World War I, and it can be negative or close to zero, as it was during the mercantilism, railroad revolution, or during the depression after the World War II, or during the financial repression from 2000 to 2019. So I mean, it really depends in which area you live. There can be 10, 20, 30 years when the equity risk premium is close to zero or negative, so the bonds have the same performance as the equities. So I mean, it's very hard to build a model that will try to predict what will be the equity risk premium in the future. Your asset allocation should probably reflect that. If you are interested in such historical long-term studies, and we really like them, there are other blog posts. I will just very quickly mention them that we have on the Quantpedia. So we have the 100 years of historical market cycles where we use our own data and we are checking what is the performance of the individual asset classes based on bull and bear market, rising falling interest rates, high and low inflation, etc. Then we have a FX carry value and momentum strategies over their 200 and plus year history. This is the paper that I mentioned probably a month ago. Then we have a paper about historical returns for US bonds since the 18th century. Then we have a commodity futures risk premium historical analysis once again from 18th century. Stocks not for the long run. So what was the US bond market performance and US stock market performance from 19th century. And then we have 100 years of risk-free rate, which is, I mean, really interesting paper because it shows what is the risk-free rate we can expect and how it was different based on the country and in the historical eras. And we can see the rates that were in the past between 2010 and 2020 that were close to zero, were unsustainable, and I mean it was like significantly different from all of the eras in the past. The average risk rate is between 3 to 5 or 3 to 6%. Thank you very much. I hope that you like this historical window. I really recommend you to go to read Brian Taylor's paper, and if you're interested to obtain the long-term data, I can really recommend the Global Financial Data, and I hope that you will join me in the next video. Thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.